Dr. Chin, it's so great to see you. Thanks for joining us this morning.
Good to be here with you, Jeff.
I'm tickled pink because we had your colleague Matthew Howell on it several months ago talking about the commercial real estate market. It's great to get to catch up again with you. Let's just talk about where things stand in 2026. What are some of the macroeconomic factors that have influenced commercial real estate and commercial real estate transactions?
Well, the macroeconomy situation has changed quite dramatically. And then what we are seeing is the three components that we need to pay extra attention to. Is number one is the GDP. Number two is the short-term policy rate. And the third, the most important one, is the 10-year treasuries. Because those three factors is going to determine our forecasting models for the investment activities.
And have we seen, just to kind of follow up on that, if I may, the capital markets we've seen some volatility, at least in the stock market, but I would assume that the capital markets are evolving for these commercial real estate transactions, that we're seeing a lot of change day to day, week to week, month to month, thus far in 2026. And probably, Doctor, it's going to continue through the rest of 2026.
It's a fascinating you highlight the stock markets. There's so many noises, daily information definitely going to impact on the sentiment, impact on the stock markets. But when we are thinking about the real estate market, let me give you the fact. Q1 number, we are seeing the investment activity up by 20% in the US, 20. And it was such a strong Q1. And also the pipeline, what we are seeing are so strong for the next quarter. As a result, we are expecting to see 2026 transaction volume is going to be up by 18%. So in the beginning of the year, we are very conservative. We say 16%, but because of resilience, strong appetite for the market, we upgrade to 18%.
That's good news, especially for investors out there. We're going to talk about that in a few minutes. Are
Mhm.
there certain sectors, for example, that have provided greater opportunity, office, retail, malls, et cetera, even AI, energy plants. But are there certain segments or sectors of the marketplace that have looked attractive, have presented opportunity?
It's quite interesting because US is such a massive country, the liquidity, the diversification, pretty much you can name every single segment. We do have a great opportunities, office, retail, industrial, logistics, multifamilies, and data center. So it's all had the various opportunities throughout 2026. But when we are looking and if you want to be a little bit contrarian, which you go off the consensus, I have to say, based on our forecast, office and retail does show the stronger returns projections for 26 and 27.
And let's talk about offices for a minute, if we may, Doctor. Uh, During COVID, I would argue maybe before COVID, a lot of people transitioned to remote work. Now companies seem to have transitioned to a remote or hybrid model. How is that impacting the aforementioned office market? It seems like it's still attractive, but maybe potential tenants are thinking about the office marketplace in different ways.
It's very funny because I just moved to the US 18 months ago. It's shocking to see that people still talk about hybrid working and remote working because outside the US, it become normal. I have to say, even within the US, the conversation about hybrid working, remote working is less relevant. And when we are looking at the office market, let me give you an example. The Q1, the office rental growth, it's across the US is well above 2%. It's back to the historical average. That's number one. Number two, the leasing activities for Q1 is actually the strongest ever since 2021. So therefore, the leasing activity for office is definitely trending up. But we're also looking at our proprietary data to look at the lease has been signed. I can quite honestly tell you, Jeff, whether you are prime or non-prime segment, the duration of lease terms hasn't changed. So therefore, we are seeing the strong resilience are coming back to these spaces. The fourth component I really want to highlight here is that people talking about space per person is going to decline, it's going to increase, over the past few years. But we also track the space per employee has been stabilized since 2025. So all of those narratives we're coming through, we have to say office has passed its bottom, is on the way to recover.
And that's good news. Yeah, and I have to certainly, I was born and raised here in the United States. I do question how, unlike other parts of the world, we cannot work remotely. But I guess that's up to the individual employer, and we'll have to see how that gets sorted out. With that being said, Doctor, let's talk about some of the technological shifts. Certainly, AI, artificial intelligence, is a big topic that you can't escape. We're talking about real estate today, but you can't escape anywhere you go. It's about AI. How is some of these technological innovations shifted the way people look at commercial real estate, or has it? Is there more automation? How does it change the operations, for example?
It's quite interesting. If you look at a real estate compared to equity markets, real estate is not transparent. So therefore, we really do not have the so-called real-time data. The data we are getting is always lagging behind what has happened. So what we are seeing is that there's so many tech-led approach has already happened among landlords, investors, and occupiers. So what we are trying to do is that they are trying to capture the building level data. And for now, by using the technology to help us have the better transparencies, better collecting processes, collecting the data in the right system. So we are in the early stage for that. And then it's very important. After we receive the data, we need to start to analyzing the data in order to design the better future for the future of the buildings, future of the space design as well. I think it's in the early stages. I'm very confident it's evolving fast. I think real estate industry is rapidly involved the way we interact with AI.
Yeah, I can't wait till we actually can have a holographic Jeff Snyder work in an office, and then Jeff Snyder can just work, be on a boat somewhere. But anyway, that's a whole different conversation. But it's clearly technology has found its way into the building and to the operation of these magnificent structures. Let's talk about indicators that maybe investors should watch in 2026. You talked a little bit about this earlier, but what should we be focused on as investors, whether we're individuals or we're large institutional allocators? What should we be focused on?
I think one thing I really want to highlight, real estate is always a function of demand and supply. And that the beauty of the current cycle for the US market, we will not have so much supply going forward. So lack of a supply will be a feature for real estate market here in the US. The demand, there's so many noises, Jeff, about the war, the AI, all the things that they think potentially going to impact the demand. But I have to tell you, as of now, the demand has showed a strong resilience, which is similar to the GDP stories what we are seeing in the US. But small investors, they really need to pay extra attention on the building they are going to acquiring, because going forward, the return is going to largely driven by rental growth. And then the second component is don't go over leverage. So that means just be prudent when the cost of finance, because the cost of finance is going to linger around, 10-year treasury is around above 4%. It's not going to trend down. So therefore, be prudent on your underwriting, particularly on the rental growth assumptions, as well as your cost of finance are super important during this cycle.
Well, Doctor, I know we talked about that the outlook is probably an 18% general return for 26, just paraphrasing our conversation. But there have to be, you mentioned the war, some of the geopolitical things going on. What are some of the near-term risks that we need to be, or we investors need to be cognizant of when it comes to investing in real estate?
Well, I keep saying to the investor can be so sensational, be driven by those sentiment and newspapers. I think
Yeah.
we go back to the demand and supply. And I do think a small investor that execute the deal, follow the underwriting, follow the asset management guideline, I think they are going to have a very, very decent returns in 26 and into 27. 26 is a vintage for the US commercial real estate market.
Yeah, well, I hope you're right, because a rising tide lifts all ships. Dr. Chin, we're going to have to leave it there. So great to have you join us. And look, we look forward to having you back on the program again very soon, sir.
Thank you.
Well, thanks for watching. And don't forget, we're back again tomorrow morning with another great expert and another great topic. You can tune in right here Monday through Sunday at 7:30 a.m. Eastern Time. And don't forget to subscribe to our daily newsletter, The Morning Pulse, for all the news in one place, delivered directly to your email box. Check it out at our website.